Why is finance so important? Prior to joining Baypath as a business faculty and director of MBA program, I spent almost 3 decades in an aerospace company. And if I would take my 30 years career and break it into 4 large categories, I spend about quarter of the time in engineering, quarter of the time in finance, and then manufacturing and supply chain and general management. Even from the time in engineering, as if you are in the audience in engineering or in manufacturing or supply chain or quality or human resource, it is clear that the two common factors in every organization, and that is true even for nonprofit, and the two factors are managing people and managing finances. So it is helpful if every person in the organization is aware of it, because every person in the organization is indirectly or directly related to organization finances. So one of the things that I have felt and we have felt in our MBA program, that even though there is a full-scale finance class, because financial and analytical skills are so important to become an effective leader and a manager, rather than just putting everything about finance in one class or 2 classes, what we have done is we have sprinkled a little bit along the way. For example, all the way from the foundation course into the marketing class, and obviously much deeper dive in the managerial accounting and finance, but even the strategy, business planning, and our final capstone class. And this way students do not get overwhelmed by finance, but just doing it in one class. More important, along the way as they're going through the journey of taking the 10 core courses, they are basically picking up a little bit of knowledge along the way, and helps them become more fluent and effective in finance, even though if they don't have a finance background before they join our MBA program. Now, so along the way, as I have been the director of the program for the last many years and teaching finance in the MBA and also the undergraduate classes, I have felt that there would be an opportunity to create a small modular workshops that are focused on finance. And so here, what I have done is created a 4-part series of finance for non-financial managers. And in these recording videos, I will cover some of what would be in a full-blown workshop, but will provide you with enough knowledge and information in some of the key elements. So there are 4 parts. Part 1 is one that I am doing today, where the focus is going to be in talking more about why finance is important for non-financial managers. And then the next one will be to connect strategic planning with financial planning, because as business leader, we have to think about growing a business, think about strategy. Strategy could be in an HR function, or could be in the operation function, or purchasing function, or engineering function. The next one, part 3, I will talk about key steps in developing a financial plan for your business. What are some of the key steps to do that? And the last one is use of financial ratios to analyze financial health of a company. So these are 4-part modules. Today I'm going to talk about the first one. So why is finance acumen important for non-financial managers? In learning outcomes, a quick discussion on balance sheet and income statement. This is not meant to be a finance class or an accounting class, so I do not plan to get into the nuts and bolts of it. I just want to provide enough information that you kind of become aware of it, what a balance sheet is, what an income statement is. But more important, the importance of taking income statement and kind of looking at it through the lens of organizational structure. what I like to call the connectivity with the organizational structure, roles, and responsibility. And also want to spend some time talking about, typically in a company, what are the steps companies go through to develop a financial plan, a budgeting setting process. So that will give you a good feel for how, depending upon where you are in the organization, how was your departmental budget setting process went through from a top-down approach. So again, two factors in every organization are managing people and managing finance. And that is true, in any company. Something as large a company that we all know, Apple, or auto company like Ford or GM or Honda, Toyota, even some local companies like United Technologies, and even with larger corporations, divisions like Otis, Carrier, or the aerospace piece of the United Technologies, insurance, Travelers, Mass Mutual. So regardless of what it is, we know that we have to manage people. We also have to manage finances. So there are two financial statements that one should become familiarized with, and they are balance sheet and income statement. There are others, obviously, statements like cash flow statements, retained earnings statements, but from a non-financial management perspective, I think what is important is that if the individual kind of familiarize themselves, what are some of the big pieces in the balance sheet income statement, they will have a good awareness and assessment of how what they do is connected to the overall performance of their organization. Now, it's also true for small companies. It could be a bakery. It could be, a franchise, a Subway or PetSmart. There also, you need income statement and you need a balance sheet. So let's start out with balance sheet. Again, at a pretty macro level, not getting into the nuts and bolts, not talking about how a balance sheet is created, but just what is a balance sheet? A balance sheet has got three key components. Assets, which is basically anything that company owns. It is theirs, they own it. The second piece is the liability or the debt. This is what company owes somebody. So if they owe money to the bank or they owe money to the bondholders, this is the money they own, and the equity is the ownership that the shareholders own. So equity obviously is, assets minus a liability, and you would, hope and expect that your assets are higher than your liabilities. Now, but what are the example of assets, right? So the assets could be a machine equipment, could be a building that company owns, could be inventory. For example, if it's a retail store, could be what you have on the shelves, because that's your inventory that you basically have. Or if you are, a manufacturing company, you will have inventory in your factory, the raw material, product that is, in process that you're making, or product that is sitting in your shipping area, not shipped yet. All that inventory, all those are assets. There are other ones like accounts receivable, cash, etc. So the overall purpose of an assets they are there to generate sales and profit. So when we buy equipment in a factory, we buy it so we can make products which will eventually turn into sales, and then sales will create profit. So from a leadership perspective, it is important that as we look at assets in our organization, they're effectively managed. Because if you have underutilized assets, be a building or an office area or a machine or a factory, or if you inventory that is sitting on the shelves or in the factories that are there but not converting into real product or sales, obviously the management needs to focus on it. See, the overall goal is to enhance the profitability as a percent of assets, which means that whatever assets we have, we want to be able to effectively use it to be able to create whatever product or service we are providing and creating very, very effectively. So one of the metrics typically is used is called ROA, or return on assets, which is net profit over total assets. And there are other ratios that I will cover in one of the later modules. But here, just to kind of point out that from a leadership management perspective, when you see or when you hear about focus on assets, typically if you are a manufacturing company, you're going to hear a lot about focusing on inventory or accounts, accounts receivable and so on. So to improve the return on assets, we have to focus on the numerator, which is the net profit, and the denominator, obviously, which is the assets. We're effectively going to manage it. So not that necessarily we want to cut back on assets. The question we got to ask ourselves is, the assets that we have, the machine, the equipment, the factory, the inventory, are those something that are core to our business because we have tied up our cash doing it? Now, where does the money come from to acquire the assets? Obviously, it is on the balance sheet, but where does the money come from? It can come from two sources. Either we can borrow money from a bondholder or from a bank, and that basically means that we're getting it from a liability, so the money will go, the debt will go up, and we'll use that money to acquire assets, or we can have investors invest. Now, when you start a company, early in the stage, you basically start out with borrowing money and investor. Or at some point, when a company wants to grow, like for example, if they want to acquire another company that may require large amount of money, in that case, they may borrow or they may get investments. But typically, on an ongoing basis, the overall goal is to be able to get cash from an operating performance. That as you're running the business, we create profit that we can then use to be able to put it back in the business. And hence, income statement is important to at least be aware of it. What are some of the pieces in there? So I'm going to do next is talk about income statement. And again, at a pretty macro level, but enough that you as individuals and managers, they may not be in finance departments, but at least will get a feel for what it is. And as you converse with your counterparts in finance and accounting, at least you'll get a feel for why some of these things are discussed are part of a key discussions in your meetings and so on. So income statement. Income statement at a very macro level is basically sales. This is the money we get from our customers, and we subtract all our costs, and whatever is left over is our profit. Now, costs, if you would include everything. If you're purchasing something, procurement costs, typically in a manufacturing company, there is a lot of procurement costs, and then that would be, an income statement will go in the category called COGS, which stands for cost of goods sold. Operations, manufacturing typically will go on cost of goods sold. If it is a company that is a service company, like an insurance company or a bank, where they're not producing product, typically instead of cost of goods sold, you will hear or see cost of revenue or cost of sales. Then there is a category called sales and general administration, typically called SG&A. What is included in there is all the activity, all the departments, all the functions that would include for things like marketing, sales, HR, accounting, finance, legal, etc. And then if the company core competency is research, and they do spend money on engineering, then you're going to find a category called R&D. And then if you have debt, the company has debt, they got to pay interest and obviously taxes. So those are the macro level costs that the company needs to focus on. And depending upon the area, the function individual is, they are directly or indirectly involved in trying to work on these categories. So if the total cost is much higher than the sales, obviously, then there is a loss. And typically what you're going to find is in a new project or a new venture or a new company, initially for the first year or two or longer, you can have a net loss. But overall, the goal is that over time, it will flip over and you will make profit. So when the sales are greater than total cost for a business, that is a net profit. So what happens to the net profit? At the end of the year, there is a net profit. What happens? So the net profit can go into one of the two places. You can take and put it back in your business, to grow your business, to invest in your business, to invest in your assets, invest in your people, or you can pay out to the dividends to the shareholders. Now, typically when you have a company that is just starting out, for the first few years, they will not pay dividends. They basically are going to put all the money back in the business. At some point, when the company is in a more sustainable and especially on a growth mode, they will pay some of it, not all of it, some of the net profit back to the shareholder as a dividend, and majority of it is put back in the business. Now, if your company is paying dividend and all of a sudden they are not performing as well, a good example, as I'm doing this recording in September of 2019, General Electric is a good example. Over the last few years, they have lost control of their business. Their profitability has dropped a lot, and in the recent past, they have cut their dividend down, which obviously is a sign that they are not doing well. So if the company is not creating enough profitability, they may not be able to give the dividends out. So a company that is sustainable growth, giving dividend out, at the same time investing, typically has an opportunity to continue to grow and succeed. So net profit is, I like to call, analogous to oxygen for the business. I mean, you can stay underwater for a while, but if there is no oxygen provided, eventually it will be hard to survive. So the net profit is essential for survival because you got to pay your bills. It's also necessary to be able to compete in the sense that sometimes you may have to lower the price to compete, and or you may have to invest to grow, and hence the profitability becomes important. Yes, you can borrow money. Yes, you can have your investor invest money, but if you continue to just do that and not have your company be able to provide ongoing profitability, it will be difficult to borrow money, and it will be difficult to convince investor to invest more money in your business. And hence the income statement management becomes a very, very key part for management team. So sustainability and growth, and also business valuation. What do I mean by that? If you look at the value of a company as far as what it is worth if you want to sell the company, it depends a lot on its ability to create sustainable profit. If the profit is growing, typically if it's a publicly traded company, it will be earnings per growth. And if the earnings per growth are better than the industry average, that company's stock price is going to be much, much better. So obviously business valuation depends a lot on company's ability to be able to sustain and grow their profit. So the company's management team has to effectively manage their value chain. Value chain basically means all the things that are necessary to be able to provide the product or services and be able to create and yield above industry average profit margin. So if a company is, for example, if a company is an auto industry will have an average profit margin. If the individual company is doing better than the average, you'll typically see that their market value, as typically measured in terms of price to earning ratios, is going to be much, much better than the peer companies. So let's look at it, organization. I just created this thing. Depending on the company that you work in, it may look different because it will depend on the product and the services. Here what I've created basically would be something that, obviously in my prior corporate life as a general manager, what are some of the key pieces, departments in an organization. What I'm going to talk basically can apply to any organization. I'm just using this as an example. So you'll have an operations functions that would include departments that would include manufacturing, purchasing, quality. Then you have the engineering, which is responsible for designing, developing new products, servicing existing products. You got sales and marketing, focusing on obviously sales, looking at the market, understanding what is going on, and having a relationship with the customers, kind of have a feel for what its competition is doing. Then you got the finance and accounting function. Their key role is to obviously manage the books, be able to provide the guidance to the management team with the financial reports, be able to do financial analysis for any strategy. Then you got human resources, which play a very critical role, obviously, in organization, because aside from finance, the other most important thing in organization is people. And there could be other G&A departments, depending on the company. You know, for example, there could be a legal department. It could be a group of people that are focused on strategy and looking at mergers and acquisitions. So these basically are, you know, your typical organization chart for some of the operating companies. An insurance company organization chart may look slightly differently, or the technology company like Apple may look slightly differently. But overall, you know, a management team is really there to manage the business, especially the income statement. So let's see how let's try to connect this to an income statement. So first thing I want to talk about is sales, which is a key part of your income statement. So who can influence drive sales? Obviously, depending on the company, if I take an example of a manufacturing type company like aerospace company or auto company, there are 3 departments that play a role in sales. You got obviously the sales and marketing, because they're going to be close to the customers. They're going to know what the product is required. They're going to have a relationship with the customers, and they're going to be able to create the sales contracts. Then you got the engineering department, obviously, because they are going to be able to provide the product, create the product, and how they design the product in terms of manufacturability, how easy it is to make or how hard it is to make, will also depend on what's going on in the operation. So collectively, in the long run, the operations and engineering work really, really well with the sales and marketing to be able to develop long-term sales. On an ongoing basis, they also work together. So even the product is on contract, is already designed, operations takes a lead role for manufacturing, making sure it's delivered on time, it is a quality product, and making it at the targeted cost. But engineering plays a role in supporting operations, because sometimes operations may need help, and sales and marketing will help because sometimes they have to go in and work with the customers. So here, you basically salespeople, the sales for the income statement is typically managed by this three group of people. Now, when it comes to cost, the big piece of the cost is cost of goods sold. That would typically be managed by the operations people, because they're gonna have a purchasing strategy to be able to decide what should they make, what should they buy, where should they buy it from, what is the commodity strategy, should they buy it internationally, should they buy it domestically. And and similarly, they will have strategy for the factory, the lean manufacturing. Maybe they will have to look at the Six Sigma process or the quality. But the engineering also plays a role, because engineering helps to make sure that collectively working with operations, that they have designed a product that is easier to make, and hence it takes less time and money to make it. So the cost of goods sold is influenced by operations and engineering a lot. Then you get into the SG&A functions, which is your sales and marketing and finance and accounting and human resources and other G&A functions, and those are the categories for SG&A. So depending upon where you are, and again, it may slightly vary from company to company, but typically what you're going to find is that engineering, R&D, typically, obviously, mostly will be managed and led by the engineering department. Cost of goods sold will be mostly by operations, but with help of engineering and SG&A, obviously the budget's managed by other department. So what I want to go next into is to talk about how are the budgets set in typical organization. Okay, so the financial planning process, where the departmental goals and budgets are set. All organizations, be profit or non-profit, go through financial planning process. Typically, around the 3rd to 4th quarter of the year, October-November timeframe, they're going to try to finalize a plan for the next year. And some companies even lay out a plan for more than 1 year, typically 3 to 5 years. The financial metrics play an important role in terms of how well they are doing, in terms of the financial ratios, and also short-term and long-term objectives and goals they have. And company's overall long-term strategy also plays a role. If the strategy is to get into a new product, or strategy is to get into a new market, and then that will play a role in how much money they want to budget for engineering or marketing. I will talk more about this stuff in the next module when I try to connect strategy with the financial analysis. But overall, at this point, I just want to talk about a typical process that takes place in an organization when you end up setting budgets at the departmental level. So, if it is a publicly traded company, the first thing will be is the senior management will set a target for the EPS, earnings per share. And that will be based on prior performance, what the peer companies are doing, and based on that, they will set a target for the earnings per share. So earnings per share basically is your net income divided by number of shares. Now, typically, at the division level or the company level, after the earnings per share targets are set, they will convert that into how many dollars of net income they have to generate. And typically the number of shares don't change during the year, so if they hit the net income target, they will hit the net earnings per share. And yes, it is true, you're going to find companies buying back some shares, so that will have some role. But typically on an ongoing basis, on a sustainable basis, buying and selling of a share, once a company is quite established, doesn't take as much. So the net income becomes a line in the sand for the company for setting the budgets for the upcoming year. Now, for the net income, they get a pretty good feel for the taxes they're going to pay. Based on the tax rate the company is, the tax strategy, they can pretty much figure out how much taxes they're going to pay for the net income they are targeting for. So that comes down to what is called earnings before taxes. So that's another line in the sand. And they also have a pretty good feel for the interest they're going to pay. They know what debt they have and what interest rate. And even if they're planning to borrow money, they have a pretty good feel what it's going to cost them for the next 12 months. From there, they will know what the interest expense is. So from there, you end up with what is called an EBIT, which is the earnings before interest and taxes. So if I start from the top, earnings before interest and taxes, from there we pay interest expense, which leads into earnings before taxes. We pay taxes, and we hit net income. If you hit a net income target, and assuming the number of shares are not going to change during the year, we basically hit the earnings per share target, which is a key parameter, especially for the publicly traded companies. Now, if it's not a publicly traded company, they still focus on net income, so the whole process that I'm discussing still applies. Now, so if you're a large company, typically going to find at the operating level or the division level, the focus in on EBIT. You're going to hear about EBIT targets, and the reason is because much of the interest expense, taxes, the operating entities, the divisions have little control over it. So that is done more at the corporate level. So the divisions are targeted to manage at the EBIT level. So now what are some of the key components of the EBIT in the income statement? You got sales. You got cost of goods sold. You got SG&A. You got R&D. And now if I look at the pieces of sales, you got the price and the quantity. So when we sell a product, at what price we sell and how many we sell obviously becomes the sales. Then when it comes to cost of goods sold, typically it is managed by the manufacturing, procurement, and quality related costs. And that would include your labor, your material, your purchasing material, your quality, and any associated overhead with it will fall in that category. When you look at the SG&A, typically going to find administrative costs, human resources, sales and marketing, finance and accounting, and engineering, is the cost that will go into R&D. And sometimes there may be some other small SG&A function that you're going to find them in the other SG&A. So now the connectivity is that the budgets of these departments, be it the manufacturing level for the labor costs, for the purchase costs, for the quality costs, any administrative costs, any HR budgets, sales and marketing budgets, finance and accounting budgets, so on, are there to be able to get to the EBIT target of the company. So if everybody does what they're going to do, and if the sales come through as they have planned, then they will hit the EBIT target. Now, from a management perspective, if you are a general manager, there's a high likelihood that everything that was set for it to stay as planned for the next 12 months, the odds are that they may change. So hence, typically going to find the leadership team will have some kind of a hedge. Hedge in the sense that they're going to say that what if something does not go as planned, because they cannot afford to miss that EBIT number, because if they do, there is not much the corporation can do on the interest expense, and hence what's going to happen is it's going to affect the net income, which will mean that earnings per share will not happen. So the management team will have some hedges someplace at a senior level, typically managed by the general manager and the finance person in the organization. Because, for example, let's say the year starts, January, February, March, April, everything is going okay, and something happens, and now the demand goes down. And so now they're selling less, the quantity goes down, or there's a competition and the price has to be lowered. So all of a sudden the sales go down. So if the sales go down, obviously it will have a negative effect on EBIT. So in order to offset that, the negative effect on EBIT, the categories of cost have to be managed. So the management team did not have any hedge. They will have to start to cut costs in the middle of the year. So typically it is prudent to have some hedges to avoid that. Now, at some point, they may consume the hedges, and hence sometimes there are some hard decisions that have to be made, either to be able to miss the EBIT target, which typically is not acceptable, and hence to be able to go into at the departmental level and look at the departmental budgets and say, we have to adjust the budget. So a lot of times when you're going to see the conversation of cutting on travel or cutting on, office supplies, is because, they want to make sure that they have some way to offset the cost because the sales are not coming through as they had planned. And in order to get back to the EBIT numbers, the departmental budget have to be adjusted. So now, the other thing is important is the cash flow. But the cash flow on a sustaining basis typically does come from the income statement. And that's why it is so important as a management team to be able to manage their income statement. Now, if you are an operating company, manufacturing type company, the other thing that is really, really important is what is called the working capital. And there are three pieces to the working capital. The first one is inventory, which means that if you have your inventory, if you are a retail store, you have material in your shelves that are not selling, that's inventory tied up. If you're in a factory and you are not converting the product fast enough so you can ship it, that's inventory. So there'll be a lot of focus on managing inventory, and we'll talk about those ratios in the later modules. Similarly, accounts receivable, sooner you can convert accounts receivable into cash, better it is. Accounts payable is in your favor. These are the contracts that you have with your suppliers, and that's why I put it in green. But then if you are paying dividends, obviously that's going to be a drain on the cash. And if you want to make any capital expenditures, if you want to buy new machines, new building, etc., that's going to be in capital expenditure. So those are the pieces also have to be planned for the coming year or even in the long term. So the three pieces that are called working capital are inventory, accounts receivable, and accounts payable. So you may find that when there is a target for cash flow, and if they are not being achieved, there may be a lot of pressure on inventory, accounts receivable, and accounts payable in your organization. So I'm going to now set the stage for my next module, which is going to be the next one. And this is where I am going to get into connectivity with the strategy. But here, let's start out with the organization. We talked about sales, we talked about cost of goods sold, we talked about SG&A. So individually within the organizations, there will be strategic activity going on. For example, in the operation, there could be a lot of lean and process enhancement process, or deciding what we make, what should we buy, or integrated product planning between engineering and manufacturing, or procurement strategy. What is a commodity strategy? What is the international strategy? What should we buy from where? Engineering will be looking at new products for the long term to be able to have intellectual property, patents, etc. They will provide them with the entry barriers, or at least buy time before the competition get in. Or looking at the synergy, should they be able to package and combine the product and sell it as a system? The sales and marketing people have an access to customers, and they kind of have a good feel for what's going on, and they can start to figure out what are the long-term competitive challenges assessment they should be looking at it. The finance department would be focusing on cost of financing. How do you get the best way to get the financing? Or especially because they play a key role in business metrics, in terms of financial metrics, what are some effective business and finance metrics that the organization can use that does not take too long, and they don't spend hours doing it, but kind of have a simple dashboard for managing the business. Organizations may have other G&A function that are focused on looking at opportunities for mergers and acquisitions or divestituring their businesses. Human resource plays a very critical role, especially in employee engagement. As employee engagement goes up, the overall performance of the organization does get better. There's a lot of research done by Gallup that supports that. That leads into the talent optimization. Some of the research that I have done in the mentoring programs that did tremendous power to be able to focus on those kinds of things. So, and key takeaways from this module, basically, and kind of connecting it with the next one that will be covered, in the future, is the financial performance, i.e. the income statement is a result of how effectively the overall value chain is managed by the management team. And the component income statements are aligned with the departments and the responsible and accountable in terms of managing the budgets. Any strategy, for example, if they want to do alliance or acquisition, and the goal is to develop financial performance, should address cost and benefit in various parts of the income statement. And the end goal of a strategy is to enhance cash flow through income statement. So overall, that becomes important. That's why in the module 1, I wanted all of the folks that are not in finance but are managers or want to be managers become familiar with at least the macro level of the income statement. So the next module will be on connecting the strategic planning with financial planning. I will take a couple of examples to talk about it, provide you with some kind of a framework, and then in the future we'll talk about what are some of the steps if you have to develop a financial plan for your business or a financial plan for your project. And in the last one, I'll get into some of the financial ratios so you can use to analyze the health of a company. So I hope this was helpful, and I look forward to doing a next one in the near future. If you have any questions, if you need help, or if you need to put together a more in-depth workshop with hands-on, please reach out to me. You can send me an email.